This Week in Economics on the 12th of February 2018 by Numbers Man from WBRN Radio in Boston and on the Bostonred Network. This is our weekly episode in the world of macroeconomics. Let's get right to it today. We have the jobs open and labor turnover summaries. It's dated on the 6th of February. And the number of job openings was little changed at 5.8 million on the last business day of December. That would be 2017. From the Bureau of Labor Statistics, over the month, hires and separations with little change at 5.5 million and 2.2 million respectively. Within separation, the quits rate and the layoff rate and discharge rate were little changed at 2.2% and 1.1% respectively. The release includes the estimate of the number and the rate of job openings, hires, separations for non-farm sectors. Job openings on the last business day of December, there were 5.8 million job openings, little change from November. The job opening rate was 3.8% in December. The number of job openings was little change for the total private and for government. Job openings increased in information at 33,000, government at 13,000. Job openings decreased in a number of industries, with the largest decrease occurring in professional and business services, 119,000, retail trade, 180,000, construction, 52,000. The number of job openings was little change for all four regions. Now, this is very interesting in that we now see the number of decreased job openings, and we look at professional and business services, over 100,000. Retail, we expected that, 85,000. And construction, 52,000 December, the winter. Hires, the number of hires was little changed at 5.5 million in December. The hires rate was 3.7. The number of hires was a little changed in for total private, for government, and for all industries and regions. Separations. The total separations, including quits, layoffs, discharges, and other separations. Total separations is referred to as a turnover. Quits are generally voluntary separations instituted by the worker. Therefore, the quits rate can serve as a measurement of workers' willingness or ability to leave the job. Layoffs and discharges are involuntary separations initiated by the employer. Other separations include separations due to retirement, death, disability, transfers to other locations at the same firm. The number of separations was little changed at 5.2 million in December. The total separation rate was 3.6. The number of separations was little changed from total private and for government. The total separation increased in state and local government. Education at 17,000. The number of total separations increased in the Midwest region. The number of quits was a little changed at 3.3 million. There was an article out there, the number of people quitting jobs, moving on to different ones. The quit rate was 2.2%. The number of quits was little change for private and for government. Quit decreased in the federal government at a negative 4,000. The number of quits increased in the Midwest region. The there were 1.6 million layoffs and discharges in December, little change from November. The layoffs and discharge rate was 1.1% in December. The number of layoffs and discharges was little change for total private and government. Layoffs and discharges increased in state and local government. Education plus 15,000. Number of layoffs and discharges was little changed in all 4 regions. The number of other separations was little changed in December, 334,000. The number of other separations was a little change for a total of private and edged down for government. For separations decreased in state and local government, including education, at negative 11,000. The number of others was little changed in all 4 regions. Net change in employment. The numbers of hires and separations occurred every month throughout the business cycle. Net employment changes result from relationships between hires and separations. When the number of hires exceed the number of separations, employment rises, as if the higher level is a steady or declining. Controversially, when the number of hires is less than the number of separations, employment declines, even if the hires level is steady or rising. Over the 12-month period ending December, hires total 64.7 million, and separations total, this is amazing here, 62.6 million, using a net employment gain of 2.2 million. These totals include workers who may have been hired or separated more than once during the year. The job openings and survey results for January of 2018 are scheduled to be released on March the 15th. So that is when we will get those numbers out here. Let's move on here. Looking at Reuters news service. We'll start out with Reuters and world shares. This is, I don't even tell you how quickly it can be read. Anyway, this is today's from the Reuters. World shares struggled higher on Monday after suffering the worst loss in 2 years, attempting to brush off the rising global bond yields, while equity futures point to firmer Wall Street shares ahead. And the high, that's the exchange, following a week of volume, including selling, lifted markets in Asia, etc. The MSCI All Country Index at 0.5%, while the European shares were up at 1.5%. Wall Street's equity volatility gauge, the IX, is the spike in which they kicked off the the action was 25.5% shortly after opening versus a 29% close on a Friday. Elaboration. Make sure that this. I just wanted to check something here in terms of. Make sure we got this right here. Okay. Okay. Eruption. Okay. Anyway, a notorious disturbance. Anyway, okay. Eruption. All right. To make sure that we got things straight here. Anyway, the bacteria could continue up. The bond yields is reinforcing the view that 10-year Treasury yields hit a new 4-year high, back to 2.9%, while the German yield benchmarks for Europe hovered at 0.8 at a 2.5-year high. People are nervous after the shock of the past week, but they don't feel like it's a crisis around the corner. But never say never. That's according to Grant Lewis, head of research at Dowie Capital Markets in London. Given solid economic growth, Lewis said the falls were most likely a wobble than a full-blown correction. the 9-year thing. Well, it's hard to say. Even at 2.9, the 10-year treasuries are still low. Well, they are low. Data from the Commodities Future Trading Commission shows equity funds have cut long positions. S&P, futures reducing exposure to the market, which fell 8% from the record 26th of January. They lost over $7 trillion. However, futures rose 1 point here. Inflation, when equity market attempts to recover, the question is whether it can withstand another sharp move up in bond yields, and that will more than likely happen. And it's something that will put to test by economic data this week. In China, the bank extended a record amount of new yuan loans in January, blowing past expectations, which is likely to support growth not only in China but underpin liquidity globally. Analysts forecast U.S. consumer inflation to be released. That'll be Wednesday. We'll have some more here. To have slowed to 1.9% in January from a year earlier, which the core is ticking down. That's kind of interesting, to 1.7%. Given the fear of fast inflation, along with Dr. Greenspan and far more aggressive rates that trigger global rout in the first place. Interesting. Nor can the central bank exhibit much concern on equity routes, indicating they tend to push with a plan to tighten the monetary policy this year. They're talking about basically 3 increases of 25 percentage points. The Societe Generale analysis said that risk sentiment bounce was being accounted by the sleeper, the U.S. Treasury curve, but the soft dollar showed that the former has the upper hand. That's on the currency market. We don't talk about that as much around here. The CFTC data shows, but speculators return money to short dollar, pushing 0.3 percentage of lower versus a basket of currencies. So the dollar is down. The euro rose 0.3% after losing 1.8% last week, while the yen eased off a 5-month high last week amidst the flight to safe havens. Sterling, this is meanwhile inched higher, off of a 3-week low it hit last week, but stayed frugal, given the signs of a shaky economy and a rocky basics. They have that. Monday, more cheerful market move also lift commodities. Brent crude futures, we'll talk about that in a minute, up 1% after last week's 9% fall. Needed a 9% fall. Commodities were too much. Gold was up 0.3% there. That is from Reuters. Amazon is buying a chip company that makes exclusive chips for Brinks, the security people, and for $90 million. I was way out there. They'll put that with CloudCam and Echo, and which the cameras can last for 2 years on a single pair of AA lithium batteries. And of course that could change. They have the Amazon camera, the efficient chip. Blinks, I'm sorry about that. Was not merely a camera business, but it was a little known owner of Meteor silicon conductor, started in Massachusetts by some chip makers in the 2000s. They sold it to San Video. They sold San Video. This is San Video to Broadcom. Anyway, they remained there, and they later left that particular place. We made our own camera. We don't have to sell 100 million chips This is from one of the owners there, Blink's security camera, which hit the market in 2016. Did not require a power cable like many of the rivals, making it easier to place around one's property. It was cheaper too, starting at $99. The Amazon wired cloud cam launched for roughly $120, while Netgear's wire-free Arlo cost still more. Netgear last week planned to spin off its Arlo business, so they're getting out of that business. I guess it's not as profitable as perhaps it could be. So anyway, the proprietary chip design will make it harder for rival retailers to copy the Amazon device. Not a very good idea there. Amazon's anyway, what they spent doing this. These proprietary chips themselves have their problem, and Amazon perhaps will wish they did not get into this. But it's short term. It's there now. Amazon owns its own chips. It's going straight to the. It can go straight to the manufacturer, cut out the middleman. Chip designers such as Ambarella, which has Go Power Inc. products. And Amazon is going to call it Plumer Labs, a division called Plumer Labs. Anyway, they're going into the video business. That's just that Amazon is reaching into many different businesses to try to show themselves up here. Let me just, attempt here to. This is a little shorter version than we normally have. We're going to look at CNBC here. We normally do look at NBC, and we go to Bloomberg. We'll just go to CNBC today. We're kind of stressed on some of our time. CNBC is an interesting outfit as far as basically the same thing. They are I wanted to get to this infrastructure program. Kind of an interesting situation in it. Some local news. Bull market looks safe now for fewer than half the correction here. Let's look at the Trump infrastructure plan. This is this $20 billion infrastructure plan to be unveiled Monday. Includes a mix of grants and loans. Now, we talked about this on our program. Includes $20 billion in federal funds. This is over 10 years. Not a lot of money when you look at it. The White House will unveil its long-awaited program. Proposal includes $20 billion in federal infrastructure spending over a decade. Would be paid for through cuts elsewhere in the budget. Plan represents an opening salvo here. The largest single piece of the White House plan is proposed $100 billion to be made available to states and municipalities in the form of matching grants, and that is not a good way to do it. But anyway, in the form of matching grants. However, it would be capped at 20% of the overall cost of any given project, leaving the states to raise 80%. Not a very good deal at all. Officials say the plan is designed to stimulate $1.5 trillion in new infrastructure investment, but did not weigh in on how the states and cities would raise the money. The proposal also includes $50 billion for rural infrastructure projects, which would be distributed to the states in the form of block grants. $20 billion would also be set aside to finance cutting-edge projects deemed too risky to qualify for traditional funding, but which would have the potential to transform, to be transformed if not successful. Another $20 million would go to expanding current low programs for public-private partnerships. And according to the White House, the federal money would average about $40 from the source. So by this rationale, we had $20 billion TIFA financing would be expected to produce $80 billion in new infrastructure. Sort of a long reach there. Details of the plan have been circulating around Washington. The plan calls for $1 trillion in federal spending, over 5 times what the Trump administration, let's see. Several pieces of the plan involve reforms to the federal permitting process aimed at cutting the amount of time it takes for infrastructure project to get started. Over the weekend, the White House emphasized that many of the objectives in the Trump plan enjoy wide bipartisan support. Still, they acknowledge that at least 10 committees in the Congress would have a jurisdiction over. So in other words, this would be a jurisdictional fight for a very long time. We usually wouldn't put this up here, but a woman in New Hampshire that won, $560 million Powerball winner doesn't want anyone to know her name out. I think that's smart. Said she won the money, but she can't cash it yet because she doesn't want to reveal her identity. Made sense to certify the financial planner. While winning the lottery can be a life-changing event, it can also come with challenges, and no doubt about that. And I would not recommend telling people. Anyway, the public can subject winners to greed and crime, so I wouldn't be broadcasting it to the world, no doubt about that. Some states don't allow you to do that. The desire to keep low profiles kept this winner called Jane Doe in a lawsuit which she filed against the New Hampshire lottery from claiming the winner. Her attorney, she wishes to continue this work and keep freedom to walk into a store without public attention, knowing she'd have $1 billion. Recommended that. Previously told them the public can subject winners. Anyway, I think we put this in here because we just want people to know that if you do win the lottery, just sort of watch out. I mean, it's not actually what you could be. Anyway, we won't spend any more time on it. Let me just... CNBC is a basket of things, but I thought we would throw that in after we looked at the infrastructure program. Not much on the infrastructure program. There have been much more solid programs out there than this infrastructure program by the Trump administration. But as Harry Reid, the former leader of the Senate, used to say, the devil's in the details here. And there is a lot of details to be here. Let's hit U.S. Treasuries while we are here. The 10-year Treasury, I think we talked about that at 2.9, not 2, yield a 4-year high. That's on the Treasuries. Was the highest there. That was at 3 p.m. Eastern time. Early Monday, the 10-year Treasury rose to a 4-year high. And I think this is what we just gave to you. And Monday, that inflation fears, thus current state of bond market, and not offering investors the safe option they usually have when stock prices go down. It's kind of an interesting comment there. This is from traders waiting for new consumer price data. That'll be out on Wednesday. I think we talked a little bit about that earlier. Bob Griffiths, the chief strategist at ECU Group, that the inflation fears and current state of the bond market there are causing problems in a normal rotation from bull to bear. You go straight to government bonds, but this is a problem with increasing interest rates going up because the economy is strong and inflation is picking up. Government bonds have become not the safest asset class on the planet, but toxic waste, he says. So by relative comparison, you sort of trapped into equities, even though you know that they are not a good value. So, yeah, in other words, that's got a problem there. Where the government bonds are going. Even Jim Carrey has got one out here to delete their Facebook accounts, dump their stock. I'm not sure what this. Let me just get this, and we'll go to the BBC. But this is analysts that predict the Dow decline shows what may be coming next. Interesting here. We know good horror anyway. The Dow's retreat is the same. The focus of interest rates in the U.S. has been a topic of discussion for more than a year, like a good horror movie. Well, 1 month ago I wrote that the Dow retrenchment was waiting to happen. We see short-term targets near 26,200 was achieved last week. Speaking on street signs, I noted that the Dow was in bubble territory. Investors who understand chart analysis have been prepared for this retrenchment. More importantly, they are prepared for the rebound and continual long-term uptrend. Forget the doom and forget the doom, because here lies opportunity. Retrenchment is when the market deviates significantly, from current trends and then falls or retreats to the underlying trend. Diverges. That's it. Yeah, the divergence between the current high and the underlying trend is very large. Then it is a bubble collapse. The value of long-term underlying trend line, which started in, according to his analysis, in October of 2011, is currently near 2,200. The divergence of 4,000 index points define a potential bubble. A retreatment to this level is uncomfortable for investors, but a rebound from the trend line supports a buying sign for a continual long-term uptrend. A retracement is a drop of less than 10% from the high index. A fall of more than 10% is generally seen as a sign of a trend change. This is a problem for the Dow. It's at 2,605. A 10% fall would take it to 2385. That is above the current trend line of 2250. 2350 is near to mere support level. This is a very small consolidation in a band between 23,200 and 23,600, but is a very weak consolidation. A fall below 2350 finds the next strong historical support level near 2250, which is a value of a long-term uptrend. Investors will look for the Dow to pause and consolidate in that area before entering again for a continual long-term trend. So he thinks that is Daryl Groupie. Anyway, that is his theorem there. I don't necessarily agree with that. We'll see where it takes him to. Let me just get one more item here before I move away from this. The bull market looks safe for now. As fewer than half of the correction deepened into a full brown bear market. They say every bull market starts as a correction, but fewer than half of all correction deepen into a bear market. Now the U.S. stock market has shed 1/10 of its value in 2 weeks in sharp correction. The fate of the downward break in prices have investors in suspense. The answer is unknown, but the weight of evidence right now suggests that we're in a nasty anxious correction, rather than the kind of prolonged downturn of 20% or more that placed the bears in control. So the bulls are running, according to them. This doesn't mean we surely seen below from this decline, even though Friday's up. And then, there was an upside reversal on Friday. We'll get to that. But some of the features of a good short-term bottom. It also might mean a quick return to record highs of January 26th, or to the kind of effortless up climb that preceded it. We probably have seen the best market has to offer in terms of gain versus path ratio reflection in low volatile levitation last year in January. Yet stocks likely work their way higher, and sturdy corporate profits as of December was winding down. The bounty of good economic news, tax cuts, enthusiasm raised, and this is something Dr. Greenspan talked about, but it can also warp into irrational exuberance. Quite simply, stocks were expensive and people owned enough of them, and in fact maybe more than enough. And for those who evaluate the market versus various fundamentals, you don't hear much about this anymore. Technical and sentiment measures. The main thing stocks have going for them by January was unrelenting momentum and refusal to succumb to routine pullbacks. The first ripple lured coincidence in a gathering storyline about inflation, rising rates, economic overheating from fiscal resurgency, hitting a full employment market, outgoing Federal Reserve Chairman Dr. Yellen and other federal officials effectively said the market's tailspin is of little concern to them. Absent the real economic effects, they don't expect. In fact, the Treasury yield were stuck near highs during the equity sell-off, meant that yield-centric defense sectors such as utilities and consumer staples couldn't rally to buffer the weakness as they've done in recent years. So this is some of the article here. It's very long, I should say. This is by Michael Santoli. Oh, Michael Santoli. All right, been around a long time. Anyway, the bears look safe for now, as fewer than half of the corrections deepen into the bull market, into the bears. I've always liked the bears, but anyway, neither here nor there. Let's finish this up here by heading over to the BBC, and let's see. Same thing here. Dow in an S&P, in a correction. The Dow ended up at 1.4% at 190 points, while the broader was up 1.5%. I'd kind of disregard that and see what happens today. The Nasdaq Composite rose 1.4%. We've seen this before. One of the problems with these kinds of situations is you get sort of a PR push out of the Dow and out of the market, where they artificially inflate the thing up. In other words, a lot of buying at one particular time, so the numbers look pretty good. But in general, you got the same market you had last week, and things haven't really changed very much. They had a Bank of England governor there, Broadbent, that the market might have underestimated the perspective of pick up inflation. This is in the UK. Big sell-off around the world this week have pinned parity on concerns over the prospect of higher interest rates. There's no doubt about that. Dow Jones fell more than 1,000 points for the second time this week. That was on Thursday. Asian markets followed downward trend with the Nikkei index down 2.3. So in other words, we got all these things that are going in. Why the market's falling? Well, we talked about that before. The jobs report there, and we actually talked about jobs openings. It was sort of a 50-50 situation, actually. Fuel expectations that the Fed needed to raise interest rates. They will raise interest rates. That's pretty performant. The Bank of England seemed to offer support for the view that interest rates in general are set to go up. That's something that's going up by the central banks, and you're going to have that. Investors' guide to the fear index. I don't know if we can get this up here. We'll see.
During market turmoil, it can feel a bit like you're on a boat, holding on for dear life. But unless you like roller coasters,
what a giddy world it is. To think that people pay to make it giddier.
Chances are you don't love that rush of anxiety.
Grin and bear it, girls. You've paid for a full share of torture.
And neither do a lot of investors. So as markets have matured, they've come up with ways to better predict when there will be market ups.
Our stock market has reached an all-time high today.
And downs, particularly since they happen faster than ever before.
The way things react and the way the markets have reacted, they react very quickly now.
So they created basically a prediction machine. You might have heard of it. It's called the VIX, or the Fear Index. It's basically like the weather forecast for the stock market. Well, the S&P 500 to be exact. A low level is like a calm sea, smooth sailing ahead. But if the VIX starts to spike, it's like the first breeze that signals a storm is coming.
There'll be another weather front overnight tonight, but
a key thing is that much like our weather forecasts, the VIX isn't entirely accurate. It often thinks the storm will be a hurricane, when it's really just a drop of water. Basically, it's a glass half empty sort of index. And this over-pessimism is something a group of investors have bet on to make quite a bit of money recently. The only problem for them is when that calm ends, they end up caught outside without an umbrella.
That's interesting. The VIX now is at a nice little level there. I mean, in other words, around 2025. We started out with the VIX. Let's see if we can get back to the VIX. Whoops. Well, somewhere here we had the VIX actually, the rate. Yeah, where's the old VIX? Well, the VIX. It closed at 29. It was at 25.5. That was when we were the ruction, the panic there. Anyway, the old VIX, that was pretty accurate for the VIX, so we won't worry too much about the VIX. Anyway, let's do the numbers here. The markets on today, actually. The BBC Global 30 at 25.003. The FTSE, these are all today unless otherwise known. The FTSE All Share at 44.51. And in Amsterdam, let me get my pointer over here, at 6.474. The DAC at 222.51. In Paris, they were at 75.76. In Brussels, at 46.79. In Madrid, at 162.40. In Zurich, at 144.42. We start to get a little red. This is from Friday. In Moscow, they were at negative 30.12. In Johannesburg, the all shares on Friday were at negative 294.82. In Bombay today, they're in the negative at 75.20 in the negative. And on Friday, the Nikkei was down 508.24 in the negative there. The Hang Seng today in Hong Kong still down 47.79. In Shanghai today, 24.27. The Dow on Friday at 333.44. And the NASDAQ at 97.33. The Merck, the commodities market out in the Midwest city of Chicago, 38.55. And in San Pablo on Monday, 1,046.17. There's something wrong here. We keep getting the same number. Anyway, in Mexico on Friday, 648.42 according to this. And on we go to commodities. Brent crude today up $1.01 at 63.80. The Wednesday, the spot was down $2.02 at $58.59. I think we can say that. West Texas crude is up today at $1.14 at $60.34. TBM picking the evening as a retirement is jumping for joy. Still got a little money in there, you know. Anyway, the Forex gold futures up $5. That was on Friday at $1,316.05. Dubai gold was down $4.10, $1,315.80. Silver was up 1 penny at $16.35. On we go to Unex Life Futures. Cocoa was down $84. Robusta coffee, you'd like to see that down $65. Eventually, there's the futures. You remember that? And the Bloomberg Commodity Index on Wednesday at 85.59. And that will do it for us. More information, obviously, will be out next week. The budget, incidentally, plan has passed. The debt limit moves on. Basically a 60-40 split between defense spending and domestic spending. Healthcare clinics were funded. The Child Healthcare Initiative, I think 6 years. And a number of other things received money. Hurricane damage, wind damaged, fire damaged, etc. They got money. So it was a bipartisan agreement that had to be obviously voted on. The military got too much money, but that is the ways, as they say, of Washington. Now it comes the infrastructure plan, how that plays in. Part of the problem here, infrastructure plan, like Trump is talking about, that's normally called stimulus. And in good economic times, you don't pile on stimulus with quote-unquote lower job. And we went through the jobs and quits. They were about 50-50 there. In other words, about 50% of the people quit, 50% of the people were hired. They were pretty much where they were. In other words, you're getting more pro forma stuff going on these days. A lot of switching took place in January. People switching jobs. We'll be monitoring that as we move along. Inflation is indeed picking up. Now, what the impact of the losses the last week on the market will have in terms of inflation, how the Fed will look at it, it's a bit difficult to say. But as we said, I believe last week we had a special program out there on the fall. And now we were, I think, at one time at $5 trillion. We're up to $7 trillion lost. A lot of money lost there. A lot of money lost in China. China came back. The ability of these economies to repair themselves, particularly ones like in China that are state-run, and not to say, in other words, there are protections in place in the UK, etc., where you have losses, but you don't have losses that turn into a contraction. In other words, a recession as such generally. But now there's still a lot of weakness out there. It's not as robust as they present it to people. In our opinion, at this mic, many of these stocks are overvalued. And we'll see how the performance goes, particularly with consumers in the U.S. and in some of these European places where they are at least 70%. We look at the UK there. Germany, even with their dysfunctional government, they're trying to get it back together. It's still motoring along, and so is France, so is Spain, etc. Better results there. The boats have sort of been lifted. up there. And this will depend on how the overall economy and look into equities. What has happened in recent years, in particular macroeconomics, we look more to equities now than we used to. We used to be dealing with the Fed and where the Fed was and the Fed's tool bank. One of the two banks they're beginning to use is the interest rates basically by 25 basis points per time. Now, there's also quantitative easing. What that does is that provides an artificial market, in other words, cheap money there. They're unwinding this. At one time, the conservatives were wanting it unwound under the administration of Barack Obama. But now the Fed is unwinding it. They're starting to scream because money will not be available as much. And this equity market scheme will gradually return to more normalcy. Now, the question will be, where will the employment numbers be when it returns to normalcy, where the bond market will be, and where inflation will be? Will this keep inflation down? Those are some questions to be answered, or inflation goes above. And now we're not talking much inflation. We're talking about 2%. Excuse me. A modern industrial economy can operate at 2.5, 2.3. This economy in the U.S. could at 3% inflation is not a problem, and even limp along at 3.5. Don't want to get too much above 3.5. 4, you got some problems. You aren't going to get there, not in this economy. But what that does is create some jobs. You still got 5-6 million people at least officially out there, out of work. You have basically numbers changing, about 50% changing, about 50% were made redundant. You're still making adjustments there. We'll see where the deals go. We're only on Q1, so a little bit different there. Colder than normal winter in much of the country, so that impacts some things, including natural gas. So we hadn't looked at heating oil. We will look at that. Energy sector is in good shape so far, and we'll see how that goes, particularly when spring driving season comes in. Petrol prices of gasoline in the U.S. has remained rather low by standards over the last few years, under $3 a gallon, so not bad. You don't have that even on the West Coast where it's more expensive than the coastal thing. Anyway, this will do it for us, those in business. Make next week a productive one for the consumer. Obviously, your eyes are on the prize. You've gotten through the holiday season. Mardi Gras down in New Orleans is out there. And what else do they have out there? Well, they've thrown in the flowers for Valentine's Day. That's coming up in a couple of days. Well, we'll have to look and see how the floral industry is doing. That's one of the consumer specialities. Don't do as well as they used to do. And I suppose you'd throw in the candy market also.